I'm with Pengana's Emerging Companies co-founder and co-portfolio manager, Ed Prendergast. So Ed, how do you define smaller companies and why should Australian investors be including them in their portfolio?
We define smaller companies as those outside the top 100. So they're kind of, if you think about the total value of the share market, about 85% is in the top 100, and then the other 15% is in 1,000 stocks. So there's lots of them, and they're well spread. And frankly, the home in an investor's portfolio to be sort of in that 5 to 10% range, because there is a certain element of higher risk. But equally, the two big benefits are they can grow a hell of a lot quicker than the large caps. You don't see the banks and Telstra growing their profits much more than sort of 10%, whereas small companies you can get 30 to 50%. And equally, it's the area of the market that is less focused on by stockbroking analysts. And what you find there is that each individual stock has fewer eyes on it, so those who do look can find hidden value more readily than an analyst looking at Telstra, because there's 15 other analysts publishing on them.
Yep. And what have returns from smaller companies been like over the last few years?
As a sector, they've been pretty volatile, so they were hit very hard in the GFC, but they fell further but bounced a lot harder, and that's the typical experience. But in a normal environment, small companies usually perform roughly in line, but they just tend to be more volatile in the shorter term.
Yeah, and one of the things that I think is interesting in your fund is that you haven't been in small mining companies at all for the last 4 years. Why is that?
Well, firstly, we don't do any mining companies, the actual mine owners, because their destiny is. We try not to speculate on things like the iron ore price or the gold price, and that's really the key driver of mining companies' fortunes. And we're not that smart or bold to predict those sorts of risky elements. But we have in the past invested in companies that service the mining industry, so they might build mine sites or clean them or dispose of the waste and those sorts of things. And that was a great sector to be in up until about 3 years ago, where we sold a lot, and it was just clear at that point in time that the mining capex usually ran at 20 billion per annum. It hit 160 in the peak, and it was never going to go to 320. So given that its long-term average was more like 20 to 40, so we just knew the party was well and truly over.
Yeah. Okay. And your fund, I think there's a couple of interesting things about it. It's capped in size, so I think you talk about it being sort of 0.5% of the small companies index. Why have you done that?
Well, there's a big trap in investments, particularly in small companies, because they're smaller, they trade less, which means the liquidity is not as high as it is in the large caps. So there's a kind of a well-trodden path of companies like ours, or funds like ours. Reasonable performance gets a lot of attention, and people throw a lot of money at the fund. But you get to the point where you're too big, and so each investment you go to make, you're pushing the share price up to get in, you're pushing it down to get out, you're creating your own performance, and there's actually a mathematical equation that says if you get to 1.5% of any index, you actually will naturally underperform that over time, and then you've got investors have to pay their fees on top of that, so it's not a great outcome for anyone.
Yeah.
We're sort of stuck to performance-based fees and keeping it very small, so that therefore the interests of the investors are kind of taken care of, in that we're not going to get stars in our eyes and try and run 2 or 3 billion. We'd rather keep it small and keep the performance.
Yeah. All right. So it sounds like it's a useful part of the market for investors to be exposed to. Adds a bit of diversification, a bit of extra excitement. So that's been really helpful. Thank you very much.
No worries.